This is why it sucks to be Tesla right now. In 2025, it sold fewer cars than the year before for the second year running, delivering about 1.64 million vehicles, down almost 9% from 2024, while its sales in Europe collapsed by nearly 30%. And yet, in the middle of 2026, Wall Street still values Tesla at more than $1.4 trillion, at over 300 times its earnings, like a technology miracle rather than the carmaker its numbers now describe. Tesla spent 15 years convincing the world it was something far bigger than a car company, and that belief turned it into the most valuable automaker in history. The belief is the problem. The same story that lifted Tesla above every rival is now the trap it cannot climb out of, because a car maker is allowed an ordinary bad year, while a miracle is not. To see how tight that trap has become, you have to start at the moment Tesla almost died before it ever really began. Tesla almost died at the end of 2008, only months after delivering its very first car. The company had been founded in 2003 by Martin Eberhard and Mark Tarpenning, with Elon Musk leading its early funding and later taking over as chief executive, and its debut product was the Roadster, an electric sports car that almost nobody had driven. Its timing was brutal. A financial crisis was draining money out of every startup in California, just as Tesla needed it most, and by that December, its accounts were nearly empty. Musk, who had poured his PayPal fortune into both Tesla and SpaceX, later said he reached the point of choosing which company to save and decided to keep both alive at once, splitting what little he had left between them. Rescue came at the last possible moment, on Christmas Eve of 2008, when Tesla closed an emergency funding round that bought it a few more weeks of life. Survival did not mean comfort. All it really purchased was the right to keep losing money on a far larger scale. 18 months later, in June 2010, Tesla became the first American carmaker to go public since Ford in 1956, raising about $226 million on the Nasdaq, and it would later repay a $465 million government loan 9 years early. That early rescue became the founding legend, the proof that Tesla could survive anything, and it quietly taught the market to price the company for everything it might one day become, rather than whatever it happened to be selling that year. Overnight, a company that had been hours from collapse was now a public stock with a story attached, and that story, far more than any single car, was what investors were really buying. Tesla became the most valuable automaker on Earth by turning that string of near failures into the most convincing growth story the market had ever seen. The turning point was the Model S, launched in June 2012, a luxury electric sedan that won Motor Trend's Car of the Year and earned some of the highest owner satisfaction scores the industry had ever recorded. Then came the Model 3 in 2017, the car meant to make Tesla affordable and ordinary, and it nearly broke the company instead. Musk called that stretch production hell and slept on the factory floor while the line struggled to push cars out the door. The market barely blinked. Even a 2018 scandal, when Musk tweeted that he had funding secured to take Tesla private and drew a settlement that cost him and the company $40 million, did little to slow the climb. In 2020, the stock rose more than 700%, Tesla split its shares and joined the S&P 500, and by October 2021, its value crossed $1 trillion. The same week Hertz announced an order for 100,000 cars. At that peak, Tesla was briefly worth more than the next 9 car makers combined, while building only a small fraction of the vehicles they did. Musk became the richest person in the world. Tesla had also built things its rivals could not copy overnight, a national network of superchargers and the enormous plants it called gigafactories, which gave the story a foundation of steel and concrete, while owner loyalty ran higher than almost any brand in the country. Tesla owners did not simply buy a car, they enlisted in a movement, and the brand stopped being a manufacturer in the public mind and became something closer to a faith. A faith has one weakness: it depends entirely on the believers continuing to believe. The cracks in that faith began at the very top, when the founder who built the brand spent $44 billion to buy a social network. Musk closed his purchase of Twitter in October 2022, funding much of it by selling more than $20 billion of his own Tesla shares, and the stock lost roughly 65% of its value across that year. That financial hit was visible, yet the deeper damage never showed cleanly on any balance sheet. Tesla had spent a decade attracting buyers who saw the brand as a statement about the planet, and Musk's increasingly political turn pushed a large share of them away from a badge they had once worn with pride. Surveys of car shoppers began to record Tesla's brand consideration slipping in the very markets it needed most, and the backlash soon spread to Europe, where sales in several major countries fell by double digits even as the wider electric car market kept growing. Owners started trading in their cars at higher rates, with some saying openly that the logo no longer matched their values. In some surveys, the share of American shoppers willing to consider a Tesla fell to its lowest level in years, and protests outside showrooms turned the brand into a political flashpoint it had never asked to become. The man who had been Tesla's single greatest marketing asset, the one whose every post moved the stock, had quietly become one of its biggest liabilities. A company built on one person's vision is never more exposed than when that person stops being the dream and turns into the controversy. By 2025, the trouble was no longer a single bad quarter, it had hardened into a pattern. Tesla had already posted its first annual decline in more than a decade in 2024, handing over about 1.79 million vehicles against 1.81 million the year before, and then it slipped again in 2025 to roughly 1.64 million, an 8.6% drop, and its second straight year of shrinking sales. Part of it was simple age, because the Model S, the Model 3, and the Model Y had all been on the road for years, while competitors kept launching newer and cheaper electric cars. The most dangerous was BYD in China, which first outsold Tesla in fully electric vehicles in a single quarter at the end of 2023, delivering about 526,000 to Tesla's 484,000, and then blew past it for the entire year in 2025, selling roughly 2.25 million electric cars to Tesla's 1.64 million. Europe became an outright bloodbath, where Tesla's volume fell almost 28% in 2025, and its market share sank below 9%, even as European electric car sales as a whole climbed more than 20%, and Germany alone saw Tesla registrations crash by nearly half. Demand that had once looked bottomless now had to be coaxed out with discounts, and a company whose entire valuation rested on endless growth was explaining its second year in a row of going backward. To defend those sales, Tesla launched a price war against itself, and the cost landed directly on its profits. Starting in January 2023, the company cut prices on its main models again and again across the United States, China, and Europe, in some cases by thousands of dollars inside a single year. The cuts kept the factories running. They also dismantled the one number that justified Tesla's premium valuation, which was its unusually fat profit margin. Tesla's operating margin had sat near 17% in 2022, the envy of the entire industry, and by 2025 it had collapsed to about 4.5%, thinner than many of the ordinary automakers Tesla had spent years mocking. Net income fell with it, dropping by roughly two-thirds year-over-year in early 2025, while the company leaned on cheap financing offers that ate even further into each sale. Every price cut moved another car off the lot and erased a little more of the premium the stock was built on. Tesla was now caught in the oldest trap in manufacturing, where a company can protect its volume or protect its margins, but no longer both at once. Legacy carmakers like Toyota and Ford trade at single-digit multiples of their earnings, while Tesla, even after the slump, still traded at more than 300 times its profits, a gap that only makes sense if you believe its next decade will look nothing like an ordinary car company's. For a business still priced as a once-in-a-generation technology miracle, looking more and more like a normal car maker was the single most dangerous thing it could do. Tesla's defense against all of this is to insist that its real value was never in cars at all, but in software, robots, and self-driving, and that argument is wearing dangerously thin. Musk has promised that fully autonomous Teslas were just around the corner for years, even forecasting 1 million robot taxis on the road by 2020. That real service finally arrived in June 2025, when Tesla launched a small robotaxi fleet in Austin, Texas, though it began with human safety monitors riding along and covered only one city, a long way from the million-car future promised half a decade earlier. The full self-driving package, sold to owners since 2016 for as much as $15,000 and later offered as a monthly subscription, has carried the same promise the entire time, that true autonomy would arrive next year, and next year keeps moving. Its purpose-built Cybercab, unveiled in 2024 as a two-seat pod with no steering wheel and no pedals, was only due to begin production in 2026, the latest in a long line of deadlines that keep sliding into the future. The Cybertruck that was supposed to be the next blockbuster finally arrived at the end of 2023, years behind schedule, then spent its first year collecting recalls, and by 2025 it was selling only around 15,000 units a year, a small fraction of the hundreds of thousands Musk had once predicted. Regulators opened investigations into crashes involving Tesla's driver assistance software, a steady reminder that the autonomy being sold as the company's entire future was still unproven on public roads. An affordable $25,000 Tesla that would finally bring the brand to the masses was teased for years and then reportedly shelved in favor of the robotaxi dream. Musk has since pinned much of Tesla's future on Optimus, a humanoid robot he claims could one day be worth more than the entire car business, another enormous promise resting on a product almost no one outside the company has seen truly working. Each one asks investors to ignore the present and pay full price for a future that always lands 12 months away, and after enough years of that, even the most patient believers start counting. Which brings us back to why it really sucks to be Tesla right now. The company is trapped between the two things it has always been at the same time, the car maker it actually is, and the miracle the market paid for, and it cannot stay both for much longer. Its sales now read like those of a manufacturer having a hard year, while its valuation still demands the explosive growth of a technology company, and closing that gap means either the business has to suddenly soar or the stock has to fall back toward earth. Here is the cruel part. The very thing that saved Tesla on Christmas Eve in 2008 and later carried it past $1 trillion, a story far bigger than its numbers, is now the one thing it can no longer live up to. A car maker is allowed an ordinary bad year. A miracle is not, and Tesla spent 15 years teaching the entire world to expect a miracle. Now the world finally believes it, and it is going to hold Tesla to every single word.